Hello everyone, my name is Srinivas Rao Kuchi. I have 25 years of experience in Australian tax. Today, I wanted to make good use of the 30 minutes you gave me to talk about the budget and taxation. This budget is based on what the people present today have introduced. It has not yet become legislation. I am speaking based on that. If you trust this and make any investments, neither I nor the Telugu Association will be responsible for any losses incurred. For any investments or financial resources, you should consult your own accountant. This is only general information. Let me make a point and explain why it matters. Generally, there are three entities that pay tax: individuals, companies, and super funds. Under the current legislation, only these three pay tax: individuals, companies, and self-managed superannuation funds or other super funds. Keep that aside for now, I'll come back to it. Coming to the changes in this budget, the first is the tax rate, and it's the only change to the rate. For the 25-26 financial year, income from 18,201 up to 45,000 is taxed at 16%. For the next year, 26-27, it's 15%. For the following year, 27-28, it's 14%. That's the only change. The government changed the rate on the 18,201 to 45,000 bracket: 16% for 25-26, 15% for 26-27, and 14% for 27-28. On some social media, it was claimed the Medicare levy went from 2% to 2.9%, but that's wrong. The Medicare levy is only 2%. It hasn't been touched. It stays at 2%. Next, whether or not you have receipts, for the 25-26 tax year, you can claim $1,000. Earlier, this was $300. The government raised it to $1,000. For 25-26, without any receipts, you can claim $1,000 as work-related expenses. Note these down if you like. The points coming up are short but important. After that, businesses with an ABN can immediately claim the full cost of any single asset bought under $20,000 rather than depreciating it. How does that work? Suppose with GST it comes to 22,000. If the asset itself is 20,000, yes, you can claim 100% as an expense. If it's 25,000, you can't. You have to claim depreciation only. Those are the ordinary changes that everyday people should know. Now, this budget made many changes to negative gearing, capital gains, and discretionary trust distributions. I'll talk about those. Once, chatting casually with friends in India, an older gentleman started on the topic of single malt and blended whiskey. He went on fluently for an hour about what each one is. When I raised the same topic with a brother here in Australia, he said, "What's there to it, sir? Why explain it for so long? One farmer, one field, one crop, one production, that's single malt. Different farmers, different fields, different crops, different productions mixed and packed together, that's blended whiskey. Full stop." Wow, how clearly and precisely you put it, brother, I said. In that same spirit, let me explain negative gearing. Since you're not in front of me, whatever question you might want to ask will fit inside the boundaries of what I'm about to explain. Okay, to the point. What is negative gearing? Suppose your salary is 400,000 and you buy a property. The property's rental income is 25,000 and depreciation, interest, council, water and strata together come to 38,000, so there's a 13,000 loss. That 13,000 loss is what's called negative gearing. You then deduct it from the 400,000 salary and pay tax on 383,000. That's how negative gearing works. Now, the present budget changed this negative gearing concept. How did the change happen? Which properties does it apply to? Which does it not? What's a new property? What's an old property? I'll use just two terms: established properties, meaning old properties, and new properties, meaning newly constructed ones. Budget day is the 12th of May, 2026 at 7:30 in the evening. For any property bought before 7:30 p.m. on the 12th of May, 2026, just signing the contract is enough. Even if settlement hasn't happened, that's fine. Any property, old or new, bought before the 12th of May, 2026, whether you live in it, rent it out, live in it a while, then move out and rent it, or move back in, do whatever you like with it, whenever you rent it out, the negative gearing rules apply. Until when? Until you sell it. Until you sell, not until you die. After you pass away, your spouse can rent it out. That's the point. The negative gearing rules apply until you sell. Bought before the 12th of May, 2026, before 7:30 p.m. on budget day. For all properties bought before that, negative gearing rules apply. For properties bought after the 12th of May 2026, the budget date, there are two categories. If you buy an old property after that date, the negative gearing rules apply only until the 1st of July 2027. After that, they no longer apply to old properties. If you buy a new property after the 12th of May 2026, the negative gearing rules apply until you sell. There's a slight twist here. Let me use two people as an example, Kumar and Ravi. Suppose Kumar owns no properties, while Ravi owns three, called A, B, and C. What do new and old property mean here? Suppose a piece of land already has a house on it. If you demolish it and build just one house, even though it's brand new, it still counts as an old property. What is the government getting at in the budget? You demolished your existing house and built only one new house, so you didn't add any supply. But if you also build a granny flat or build a duplex, then it's treated as a new property. Demolishing one house and building one house keeps it as an old established property. Let's go back to the start. Kumar owns no properties. Ravi owns three, A, B, and C. Now, after the 12th of May 2026, if Kumar buys an old property, the negative gearing rules apply only until the 1st of July 2027 and not after. What does he do with the loss? Keep carrying it forward? When he sells, these losses can be taken out of the capital gains. I don't want to get into capital gains here. I'll come to capital gains only after finishing negative gearing. If Kumar buys a new property instead, the negative gearing rules apply until he sells. Now, Ravi owns three properties and right now they're positively geared. Across the three, his household runs on $28,000 of positive gearing. Suppose Ravi buys an old property, call it D, and D has a negative gearing loss of 15,000. What's the main aim of this budget? The government's concern is that if your salary income is 4 or 500,000, you take your negative gearing loss, reduce that income and pay less tax, taking a big advantage. Here's the point. Across A, B and C, you have 28,000 profit and property D has a 15,000 loss. You can offset that loss. So Ravi's income 180,000 plus 28,000 positively geared minus 15,000 gives a taxable income of 193,000. So for Ravi, whatever property he buys, if it's negatively geared, what's the government saying? It's saying don't deduct this negative gearing from your salary. It is not saying you can't use it against your other positively geared properties. A, B and C give Ravi 28,000 in positive gearing. If he buys property D, old or new, with 15,000 of negative gearing, that 15,000 can reduce the 28,000. Ravi bought an old property with a 15,000 loss. He can use that 15,000 loss against the positively geared A, B and C. And if Ravi buys a new property as before, the negative gearing rules apply until he sells. I've also covered the second case, buying an old or new property after the 12th of May 2026. As for buying a new property, again, you have to check whether it really is a new property. Whether it's from Mr. Rama or Mr. Raj Gunam, if someone calls it a new property, you need to check it yourself. You have to check, did you demolish an existing house and build a new house or build a duplex? Or was it vacant land before and you've now built a house on it? Does it fall under the new property classification or the established property classification? If it's a new property, negative gearing applies until you sell it. Now the further doubts you'll have. I have 25 years of experience, so I usually know people's questions in advance. For instance, sir, I have a trust, it owns a property, I'll transfer it to my son. Can my son use negative gearing? The answer, the trust is separate, you are separate, your son, your wife, your daughter are all separate. Nothing is combined. If you transfer the property from the trust to your son, that counts as a sale, the trust selling to your son, so negative gearing doesn't carry over. Whether from a family trust or a company or a property in your own name transferred to your son, it's treated as a sale, so the same applies. One of the three rules I gave earlier applies. Whether you transfer from a trust or from your own name, the same rules apply. That's the negative gearing picture. In negative gearing, I covered properties held before the 12th of May 2026, old and new properties bought after that date, that if you already own three positively geared properties, you can use the loss against them. What happens when you buy a new property and how transfers work from a trust or from your name into your son's or daughter's names. All of that was for individuals only. Now, how it works if you buy property through a self-managed superannuation fund and through companies, I'll come to next. Any accountant can do self-managed super funds. I do them, so does my brother Gopalakrishna Getiganti, Venkat Kantepudi, Dantu Vijay Sarath Reddy, and the young Kishore Raja Ellamanchili. Why did I say young Kishore? Because he's the youngest of us all. Any accountant can do this. We are speaking Telugu on Telugu radio, and since this belongs to everyone who speaks Telugu, I mentioned my brother's names too. Coming to capital gains tax. Just as in Tamil Nadu, the DMK and AIADMK held power for 60 years, and then power was newly handed to Vijay, a big change, the same kind of change has come to capital gains tax. If the comparison is wrong, forgive me. If it's right, take it. What is pre-CGT? Any asset bought before the 30th of September 1985 is called a pre-CGT asset. Suppose your parents came to this country in 1975 and bought 5 acres in Marsden Park or Epping, which were forest then, for $10,000. Today, those are worth hundreds of millions. Under the current rules, even at 100 million, there's no tax at all on them. Those are pre-CGT assets. Properties bought before the 30th of September 1985 are called pre-CGT. What has the government now done about this? It says, no, this can't go on. How much longer will you enjoy these benefits? Let's stop it. So, after the 1st of July 2027, if you sell, you take the property's valuation as at the 1st of July 2027. Say you bought it for 10,000. Now suppose it sells for 1 million. 1 million is the sale price. All of this is after the 1st of July 2027. 1 million is the sale price, 10,000 is the purchase price. Whatever the gain works out to, around 990,000, the government brought in a policy. Take off 50% and pay tax on the remaining 50%. Let me say it again. After the 1st of July 2027, if you sell any property, whenever you bought it, purchase price 10,000, sale price 1 million. From 1 million subtract 10,000, then 50%. After the 1st of July 2027, say you sell in July, August or September, take off the 50% discount and pay tax on the rest according to whichever entity, individual or otherwise is selling. Okay, say I bought a property on the 1st of July 2017 and sold it on the 1st of July 2027. This is a simple calculation. Purchase price 500,000, sale price 1 million. Profit 500,000, 50% discount, pay tax on 250,000. The 50% discount applies straight away. Now suppose instead of the 1st of July 2027, you sell on the 1st of August 2028. You bought for 500,000. Its valuation on the 1st of July 2027 is 800,000. So up to that date, the date where the government removed the CGT 50% discount, your value rose by 300,000. Then suppose that 800,000 property is sold on the 1st of August 2028 for 900,000. Here you calculate capital gains tax in two parts. From 500 to 800,000, the gain is 300,000. On that, the government gives the 50% discount. So 150,000 of gains there. The amount that rose from the 1st of July 2027 to the 1st of August 2028 is 100,000. Does that 100,000 get calculated under indexation rules? What is indexation? Those listening may be cleverer than me, may know more than me. I'm speaking within the limits of what I know. The way to calculate it, future value equals present value multiplied by 1 plus r, all to the power of n. So this indexation, say inflation is 2.78% each year, means 800,000 into 1 plus 0.0278 to the power of the gap from 2027 to when you sell, and you get the indexed figure. On that indexed gain, the government wants a minimum 30% tax. Here we had 150,000, and from 800,000 up to 900,000, a 100,000 increase. On that 100,000, it wants a minimum of 30%, that's 30,000. CGT is calculated that way. Here, the value you bought at is 500,000. On the 1st of July 2027, it's 800,000. The rise is 300,000. The 50% discount applies, giving 150,000. For the rise between 27 and 28, the indexation rules apply. That's the capital gains story. Here, the government added one catch. If, after the budget, after the 12th of May 2026, you buy a brand new property, say today you buy a brand new property for 800,000 and sell it about 4 years later for 1.2 million, a 400,000 profit, then only on this 400,000 does the 50% discount apply. It can be a bit confusing the way it's written. Let me repeat the same point. If today you buy a brand new property for 800,000 and at some point sell it for 1.2 million, you make a 400,000 profit on sale. On that 400,000 profit, the government says it will give the 50% discount. Why? Because the aim is increase supply, increase supply, increase supply, buy new houses, build new houses. With that aim, the 50% discount applies. That's capital gains in the individual's capacity. Among the major changes, I've covered negative gearing and capital gains. Next, the matter of trusts. It can be a bit confusing, but I want to cover it. When does this trust taxation system change? Not this year, not next year. It changes from the 1st of July 2028. That means trust tax returns change for the 28-29 financial year. What changes? As I said at the start, currently only three entities pay tax: individuals, companies, and super funds. Now the government is bringing the same change to trusts. It's saying that after the 1st of July 2028, trusts must also pay tax. These are discretionary family trusts. Take a discretionary family trust. Suppose there's a doctor who brings all his income into the family trust. After all expenses, just to keep the example simple, I'll take 30,000. No doctor earns that little. It's only to keep my example simple. Say 30,000 is left after expenses. The government says, before you distribute, pay me 30% first, then distribute. 30% of 30,000 is 9,000, pay that to the tax office first. After paying 9,000, 21,000 is left. Now, the doctor also works elsewhere. His salary is 3 or 400,000. Set that aside. He has an elder daughter, beneficiary A, and a son, beneficiary B. The accountant advised him to set up a beneficiary company. A beneficiary company is commonly called a bucket company. So in this family trust, the beneficiaries are the son, the daughter, and a company. Of the remaining 21,000, say he gave 7,000 to the daughter, 7,000 to the son, and 7,000 to the company. The elder daughter gets 7,000. She doesn't work anywhere. She's 19 and doesn't work. The accountant said, give your daughter 7,000. With 3,000 of franking credits, the income becomes 10,000 and 3,000 comes back. After the 1st of July 2028, the elder daughter lodges her tax return. Sir, I received 7,000. I got franked dividends, 3,000 of franking credits, total income 10,000. My income is only 10,000. Below the threshold. Will you give me the 3,000 back? The answer? No, sorry, you don't need to pay any tax. These are called non-refundable tax credits, so we won't give you the 3,000. So even with 10,000 of income and 3,000 of franking credits, you won't get the 3,000 back. Yes, what you're hearing is correct. Now suppose that daughter also has another 100,000 of income from somewhere else. Then her tax bracket, including the Medicare levy, is 37%. In that case, the tax office says, you only paid 30% on that trust distribution, pay another 7%. You paid 30% inside the trust, so pay the extra 7%. Same with example B, the son, the daughter and son are in the same bracket in this example. If income is only 10,000, no 3,000 comes back. If the income is higher from elsewhere, you've paid 30% in the trust, now pay the remaining balance. This applies only to family discretionary trusts. By contrast, if that girl invests in Vanguard or an MLC public listed trust, these rules do not apply to those franking credits. I've covered example A and example B. For C, the bucket company concept is killed. There are no more bucket companies. After the 1st of July 2028, they're as good as living corpses. If you distribute 7,000 to a bucket company, the 3,000 already paid in the discretionary trust is not carried forward. That 7,000 is taxed again at 30%. The 7,000 distributed to the bucket company is taxed again. Because of that, the bucket company concept is killed. On the same theme, there's a Telugu-speaking financial planner named Raghu Vattam. You can find his number on Google or his website. What kinds of trusts to set up and how, you can also ask a financial planner. Here's the thing. Even if we know the mantras, we can't perform the puja. In the same way, we are GPs. Just as a puja only counts when it's done by the priest, financial planning is only legitimate, only legalized, when the advice comes from the financial planner, from their mouth. That's about trusts. For companies, generally there are no changes. The negative gearing rules that apply to a property in a company still apply, and the negative gearing rules for a property in a self-managed superannuation fund still apply. Suppose we take a company. Inside a company, you're running some business with, say, a small trading income, 21,000. The company also owns a property which produces negative gearing of 18,700. Whether the property is old, new, or demolished and rebuilt, it's all the same. From a profit of 21,000 after deducting negative gearing of 17,700, taxing the remaining amount of over 2,300 will be sufficient. These negative gearing rules mostly apply to individuals. For companies and self-managed superannuation funds, the rules remain the same without any changes. This is the information as I understand it, and I wanted to share it. There are some questions from listeners on this radio show, and I will answer those questions to conclude.
You gave us very good details, Srinivas Garu. I learnt a lot today, but I got stuck at one point. What you said was when you came to Marsden Park in 1980 and bought about 5 or 10 acres of land. I stopped right there. Oh, how lovely, Srinivas Garu.
Those daydreams are very pleasant, ma'am.
So I have 2 or 3 questions. My father sold a property in India. If he sends that money here, do I have to pay tax?
Okay, look here, ma'am. The property sold is in your father's name. Your father is a taxpayer in India. That's it. It has nothing to do with Australia. He sells the property there and pays whatever tax applies. If he sends the remaining amount to your bank account, it comes as a gift, no tax, no. But India has also brought in new rules. What are they? If you send more than 7 lakh out to other countries, they've put a 20% tax on the remittance. You should discuss that with an accountant there. Coming back to here, when your father, mother or in-laws send money to your account, your husband's account or your son's account, the tax office may ask where it came from. If you bring that letter and show it to them, you don't need to pay any tax, ma'am.
I have another question, Srinivas Garu. I own a property in India in my name. If I sell it, do I have to pay tax?
Here's the point. People ask this in many ways. The first thing I ask is, when did you buy the property, ma'am? You say, we bought it in 1995 for 10 lakhs. Then I ask, when did you come here? You say, I came in 2012, sir. When did you sell it? We sold it in 2026. Okay, we tell you, when you arrived in this country, get the property valued. Say the valuation then was 20 lakhs. So when you came here, the property's value was 20 lakhs. In 2026, you sold it for 1 crore rupees. How do we calculate capital gains tax here? What does the rule say? Calculate the tax according to Australian taxation rules, then disclose it. So, a property worth 20 lakhs in 2012, subtract that from the 1 crore sale price, the gain is 80 lakhs. We divide that 80 lakhs by 2. We tell you 40 lakhs is tax-free. We convert that 40 lakhs into dollars. Say it comes to about $80,000. Sorry, not 300,000, about 80,000. What would you have done in India? You'd have paid tax on the 80 lakhs. If you paid 10 lakhs of tax on 80 lakhs, since we're taking half here, that's 5 lakhs. On the $80,000, you've already had 5 lakhs of tax calculated in India. I take its value as about $12,000. I add the 80,000 to your taxable income and treat $12,000 as tax already paid. I calculate. If there's more to pay, you pay the rest. Because those $12,000 were paid in India, you get nothing back here. That is, you won't get anything back from the tax office for the $12,000 because you didn't pay it to the Australian tax office, you paid it to the Indian tax office. Again, a simple example. You bought in India for 10 lakhs. When you came here, the property was 20 lakhs. You sold for 1 crore. Profit 80 lakhs, the full amount. We take 50%, 40 lakhs. Whatever tax you paid in India, we offset it. We convert to dollars. We convert the 40 lakh income to dollars and add it to your income. We treat the offset tax converted to dollars as tax already paid. If there's more, you pay it. If it's less, you get nothing. That's the simple answer. Do you have to pay? You may have to. How do you lodge your tax return in India as a resident or a non-resident? If you lodge as a non-resident, they'll ask, which country are you in? Australia. You put your Australian tax file number, you can't lodge the return in India. And once you use the Australian tax file number, they can find out at any time that you sold property in India. It's good to take that precaution.
Also, I've sent money from here to India many times. If I bring it back here, do I have to pay tax?
As long as you have the proof that you sent the money to India, if you bring it back normally, you don't need to pay any tax. There's what you sent and there's what you brought back. They'll ask, where did this money come from? If your explanation satisfies the tax office, you don't have to pay tax on that amount.
So, does proof mean ordinary bank transfers or something else? So,
Anything, ma'am. Whatever exchange you sent it through, having that proof is enough.
I have another question. A person named Murali bought a property in India in 1980 for 1 lakh rupees. Today, it's worth nearly 50 crore rupees. If it's sold, does tax have to be paid? What's your advice?
I recall a case like Murali's coming to me some time ago. Around Hyderabad, bought sometime around 1980 or 1982 for a lakh or 10 lakhs, and it's gone up to nearly 100 crore. I did a little research on this, talked with chartered accountants in India and with the client. The advice I gave, he's 68 years old, his children are grown, everything's settled, there's nothing keeping him here. He should go to India and sell everything, keep no car, nothing here, cut ties with Australia, go to India and effectively say bye bye to Australia and leave. Once he leaves here in Australia, he becomes a non resident. He enjoys India for about 3 years and sells everything. He pays the tax in India itself. While still in India, he decides what to do with the 50 crore, so much to the wife, so much to the sons and daughters, washes his hands of it. And if after 3 years he says, India's gotten boring and comes back to Australia, that's the safest method. First leave from here. Otherwise, if you stay here and sell, you pay tax there, then you also have to calculate and pay the excess tax here, an unnecessary headache. If it's feasible, do it that way. Otherwise, they're saying he bought it in 1980, and the point here is that this is before the CGT period. In Australia too, the rule only comes in after the 1st of July 2027. When he brings the 50 crore, he says, Sir, I bought it in 1980, it's a pre-CGT asset, I don't need to pay tax. And yes, that's correct, no tax is due. If he proves he bought it in 1980, it's a pre-CGT asset, no tax due. If he bought a piece of land and built a small house on it in 1990, the house is a post-CGT asset and the land is a pre-CGT asset. When selling, how much is the land, how much is the building? There's no capital gains tax on the part from the land. That is only up to the 1st of July 2027. On the profit from the building, you pay normal capital gains tax.
Thank you so much for giving us this much information. Thank you so much for giving us this much.
Thank you, ma'am. Thank you for listening patiently, and many thanks to the Telugu Association and to the two of you here for this opportunity. Here are my contact details, and feel free to contact me for your accounting and tax return purposes.